Hello, everyone, and welcome to the Upside Ticker Talk, episode 4. Today's episode, we're going to be focusing on, you guessed it, the ETF industry, but from the lens of a market maker. So a little bit of a different twist, and we've obviously got a great guest joining us today, our first external guest joining the show. So we're really excited about that, and I guess it's a perfect timing. I guess change of seasons, summer's over, got some new and exciting stuff for everyone. As always, we kind of do a quick little recap of our last episode. So last time we had the chance to host Rory Poole, who's our director of alternatives. Rory had took the time to explain basically everything alternative investing with us. What's the difference between a liquid alt, a non-liquid alt, the different types of alternative strategies that we see here in the Canadian ETF and fund industry. We also did some rapid fire, which was fun, on asking him if an antique was considered an alternative, asking him if trading cards were alternatives. Basically, it was a good little 40-minute episode, and you can catch that on YouTube, your favorite podcast app. We're always saving all those episodes. You can go back and watch them if you want to. Let's introduce our guests. So today we're joined by Patrick McEntyre. Patrick, thank you so much for joining us. Co-head institutional sales for ETFs, portfolio trading, electronic trading, and equity derivatives at a national bank. It's a mouthful, but
it's a lot of things. I wear a lot of hats, and they just keep giving me new hats. And that's the idea at a bank. You want to have like lots of bosses, a cheap mortgage, and lots of different jobs.
That's perfect. I mean, Patrick's been in the industry for quite a while, more than 25 years. Yep. So you've been around the block. You've seen the industry grow. You've helped grow this industry as well, playing a really pivotal role in growing the largest, market making desk in Canada. So, beyond his expertise, got great stories to tell, and I think everybody's going to really enjoy some of sharing his insights. And we're going to go into answering your questions from the internet. I've got questions for Patrick. So I mean, we're going to get right into it in a minute. But before we do that, also a quick little recap of our kind of market trends that we've seen over the past month. We're going to get Patrick's insights on that as well. So a few things I jotted down that I think were worthwhile for our audience to note. I mean, today is Fed decision day, so that's going to be interesting. I know Bank of Canada announced a cut. Inflation has continued to come as expected, maybe slightly below, but there is a consensus, it feels like, among market participants that there will be a cut by the Fed, so kind of restarting their easing program, if you will, that they halted a while ago. Another thing that I noted, gold continues to be one of the best performing asset classes this year, and I think for a lot of investors, a lot of advisors, that's something that I feel like it's been part of the asset mix for a long time, or it's been considered as part of the asset mix in a diversified portfolio. But with the ramp up that we've seen this year, which is more than 30% in returns for gold bullion, it feels like it's come once again kind of back into the forefront. Lots of factors playing into that: weaker USD, central bank buying. Those are two of the notable ones that I had noted. But fourth point, U.S. equity markets since April have continued to outpace global developed markets, even emerging markets, albeit year to date. We can take a kind of a bit longer look. We do see international markets slightly outperforming U.S. equity markets, but overall it's been quite a strong recovery post-March. I guess the last point I had is still with regards to U.S. equities. It feels like we've gone back to a concentrated market. 30% of stocks or so are outperforming the benchmark, 70% underperforming. So it feels like we're right back to 23, 24 type feel from a stock selection standpoint. But those are the headlines I had. I don't know if you have comments with regards to any of that or anything else that you've seen that stuck to,
Yeah, listen,
stuck out.
The level of risk on and bullishness that we're seeing amongst large sort of asset allocation clients, which are who I look to think about where's the real money following. Yeah. The risk on atmosphere is alive and well. Like it's really been surprising. And if I think about kind of a year and a half ago, the pessimism that reigned, and then Trump changing everything, the Trump trade being on, tariffs really taking a lot of air out of that U.S. equity market, a lot of the air out of the equity markets in general. We saw a lot of diversification into international, saw a lot of scared money run for fixed income. And in the months since then, on the rally that we're sitting on, albeit a narrow rally, the fund flows are towards risk assets. And honestly, the chatter that we hear out of client side is extremely risk on. Like it's quite something. So if that makes your contrarian like bells dingle, like good luck, because definitely when we see the whole market to be one side, it's always a bit scary. Yeah. But at this moment right now, it is very much risk on, which is again kind of wild.
Interesting. Yeah, and I think it resonates also with what we're hearing, what we're seeing when talking to clients. It feels like defense is just like nobody's really looking to add defense right now, which to your point is a little bit alarming if you are a contrarian. I mean, in your title, derivatives, it also mentions, I feel like we always see that like put to call ratio and things like that. And it feels like it's definitely tilted towards risk on anyways, unless I'm on the contrary. I think that's another kind of way to look at it. But if we look at it, one thing that we do at Fidelity, obviously, we're biased here. We're for Fidelity. We got to talk a little bit about what we do. The factor side, like momentum, is the one thing that's working really across regions, and that's really telling of kind of that risk on appetite and kind of crowding a little bit to a certain extent, but really good, really interesting.
You know what? When I talk about multi-factor investing to large investors, which I do, I speak to like actual stock equity issuers about this too. I'll explain to an oil and gas management company why the quants are buying their name or not buying their name. And when I break down factors, which I believe strongly in because I'm a program trader, I love value. I love low vol. That's my favorite. But the momentum factor is the one that kind of makes people's brains bend.
Yeah.
Because it is what it sounds like.
It's such a good point that you make, because momentum, people have a hard time wrapping their head around because it's just so contrary to everything they've learned in their CFA or their BCom or whatever finance classes they took is buy low, sell high. It's not buy high, sell higher.
Yeah,
a lot of people have a hard time wrapping their head around that. It's funny. It's like you want to own some because it works and you believe in it. It's out there. It's in the ecosystem. Tough to do like in practice, like if you're like a stock picker. So that's why there's ETFs for that, I guess, that you can package them. So that's good. So that's kind of the quick little market recap. Let's dive into the industry. And this is obviously there's no better guest I think than we could have on to describe that. Me and Andre do it once in a while. Obviously we try to keep track, but you guys are right in the thick of it in terms of and a lot of the data that I use comes from you guys. So hopefully my number is okay with what I'm quoting here.
Rock solid.
7.4 billion in August. So slight slowdown from July, but still bringing the total basically up into we're basically at now, I think, with the first 2 weeks of September at the yearly total of last year, which was a record-setting year.
Correct.
So strong momentum in the Canadian ETF industry through the volatility, through the recovery. It seems like nothing slowed down. Also, it feels like there's less and less seasonality. It used to be like Q3 was a bit slower. I don't know, in my mind anyways. Maybe it's because I was just doing less meetings myself. But international equities continue to outsell U.S. equities, Canadian equities. Canadian equities actually in outflows, I think, in August. Some other notes that I took that, albeit the international number looks quite high, there is a lot of demand for global, I think, equities as well. Multi-asset ETFs, that's really where we've carved out quite a niche at Fidelity. FBAL, FEQT, FGROW, 3 of our asset allocation ETFs being in the top 10. So we're really happy with that. And thank you, everybody, obviously, who's helped us get there. But that category as a whole feels like it's growing. Some of our competitors enjoying positive flows as well. On the launch side, 36 new ETFs in August. I feel like this year it's probably in the hundreds total, at least.
Oh, it'll be a record year for new issuances, for sure.
Like crazy, right? So so those are like the main comments I had. Oh, the last one was levered ETFs, 605 million. That's a record month for that category. So I mean, any comments? I know you added a few things there, but like things that stuck out to you notably in the last month, but just like year to date, because I mean, I don't know when's the next time we're going to get to chat. So let's take a bit of a longer perspective as well on like things that you've seen this year.
Yeah, like so one of the things that stands out to me from those flow numbers and from just the sheer money flow of it is the asset allocator ETFs, or the one ticket solutions, depending on your or all-in-ones is the other term.
Yep.
What do you guys call them?
Well, ours in the name is all-in-one ETF. So I'd like to,
all-in-one's what I go. AIO. Here we are.
AIO. There you go.
It has delivered solutions in a way that none of us had really foreseen on the cap market side.
Yeah.
I believe the segment is $50 billion.
Holy,
now.
Is it 50 billion now?
Yeah, so it's over 10% of the Canadian ETF market is now single ticket solutions or all-in-ones.
Crazy.
And what has been surprising about that is that these are really simple vehicles. Yeah. And that is what ETFs were originally built for, right?
Absolutely.
If the original ETFs were like super boring indexes, it was like the TSX SB60 or the S&P 500 in the US. The original reason that the ETFs were designed was to deliver cheap exposure to broad equity asset class. Over the ensuing number of years, they became multi-asset. There's fixed income, there's commodities, there's all manner of covered call and sexy stuff. But the one-ticket solutions, or the all-in-ones, they're really going back to that OG
mentality,
purpose of what an ETF was meant to be. And the fact that I've seen those be so successful, and again, I'll be clear, when the first ones were designed, I was like, you're crazy, no one wants these. People like to own lots of things, not one thing.
They want to see a lot of lines in their portfolio.
But it's not true. Like when you're managing either your home portfolio yourself or you're with an advisor, you have multiple portfolios. And so you may have one large portfolio where you want to add some sexy stuff, some hot sauce.
Yeah.
Most of your other portfolios are really simple, and they just want to have good exposure to asset classes that will accrue over time, period. And there'll be savings vehicles that can take small increments of money as you save them and grow consistently. And that's what the all-in-ones have delivered. We have a graph in our report last week. It will show the growth not only of the total assets in this segment, but the flows into it grow every month.
Oh,
so like the derivative of growth is growing. It's astonishing.
Yeah.
And that underpins to me, like as I said, the original purpose of these ETFs. Which the flip side of that is the other thing you mentioned is the record new issuances.
Yes, the complete opposite idea.
That's right. So there's only so many FBALs you can make.
Absolutely.
So if there was there was 20 new issues yesterday, okay. None of those were another balanced fund, right? So like the proliferation of these line items, of these new ETFs that are coming, are for the most part much more specific, segmented, targeted, or thematic expressions of risk. To a large extent, many of them are single stock ETFs.
I need to pick your brain on that because I think a lot of people have heard about them, and I guess okay, I'll ask you that. One quick thing before we get to the single stock, the multi-asset stuff. I was talking with a colleague in the U.S. that has a similar job that I have here, and they're like, multi-asset ETFs they're not as popular in the U.S.
True.
Is there a reason for that? Is it just because maybe it's just people just buy U.S. domestic equities and they're not looking for external or to diversify.
So first of all, the typical U.S. investor just buys the S&P 500 and drives on, and it for the most part works out, so they keep doing it.
Yeah.
But the other sort of more nuanced answer, and I don't have it fulsome for you.
Yeah.
But in the U.S. there exist these. They're called LifePath, or I think
here we've got ClearPath at Fidelity.
LifePath.
Yeah.
So BlackRock has LifePath. You guys have ClearPath. But they have these products that are custom built to change exposure over time, and they're already delivered via workplaces or via other investment vehicles, and so they essentially they don't need the one ticket solutions the same way that we do.
Okay,
and it is what I'm told.
Okay.
Now, when I'm presented with somebody tells me that they don't need it, then I'll just be like, well, how can we build it differently so you do need it?
Yeah, exactly.
Because it has been enormously successful here, and like Absolutely. I say, just the simplicity of that solution, and the reason I brought up all these single stock ones, which we can get back to.
Let's go.
Is what's the opposite of an ETF that holds one stock? It's one of these all-in-ones,
2,000 or 5,000.
Yeah, it owns 3 to 5 ETFs that own thousands of stocks and some bonds. Like that is the simplicity answer to the complexity that the proliferation of ETFs have brought. So what we've seen, to get back to your what am I seeing, what we've seen in the ETF industry in the last number of years, and it's exaggerating itself now, is this notion that there is sort of two barbells ends of the ETF business. There is plain Jane vanilla beta multi-asset returns, and there is levered sexy hot sauce on this side. Things in the middle don't seem to have a real place in investors' portfolios. Advisors are doing something different, or they're not doing it at all. In fact, if I was going to start a portfolio tomorrow, I would have 85% cheap beta and 15% cool stuff.
Yeah.
And those are the two things that I would want to have. I wouldn't have the middle stuff at all. And that's what we've seen. We've seen especially
high active share, no active
self-directed investors want some cheap beta, and then they want some stuff where they can express real bets, views, get exposure to what they feel is going to to make a turn, and that's what we're seeing. So that's what's working.
Awesome. No, that's great, and thank you for that. I guess last questions on kind of this industry stuff. We were about to go into it, and I kind of messed this up and threw us off. But single stock ETFs, you just kind of explain what those are a little bit, because I feel like there's a misunderstanding that there's no leverage in those, but there is for the most part. Am I correct in saying that?
You are correct.
So it's not like you're buying a Tesla ETF that only owns Tesla and you're getting the exact rate of. It's not like a different vehicle to own a stock. It's a levered way to own it's a multiplier.
Well, it is a different way to own a stock, but
it is a different way to own a stock, but it's not a one-for-one relationship of performance upside downside.
So right now in Canada, I think there's roughly 85 different ETFs that hold a single stock.
Okay.
All but 8 of them also have covered calls in them.
Okay.
And all but 5 of them employ leverage.
Okay.
Okay, so other than
we
those,
can make that assumption.
Other
that
than those
all of
like
them-
13 and of those 5 and 8, some of them are actually the same one.
Yeah.
So like for the most part, the single stock ETFs that we're talking about here, and so we're going to generalize around the ones that are lightly levered, and have covered calls. Okay, so most of them they employ a vehicle where they're holding, for every dollar of cash in the ETF, they're going to hold 1.25 exposure, or recently there's some that are at 1.33. So that's 33% leverage or 25% leverage. And at the same time as having that leveraged exposure to the single stock, they are also writing calls. So they're selling call options on that stock to generate some income. The view here being that sometimes you want exposure to Tesla.
Yeah.
Because you are excited about Tesla's prospects. Let's assume you have a real view on Tesla. We can use Apple if you prefer. Are people mad at Elon?
I don't know.
No. So you want to be exposed to Tesla, but Tesla doesn't pay a dividend.
Yeah.
And so you'd like some income.
True. Yeah.
So if you write some calls, you sell some options against Tesla, that will get you some income and gets you a dividend on a stock that doesn't have a dividend. So we're essentially using financial engineering to generate a dividend on a stock that doesn't have a dividend. Leverage is applied to help participate in more of the upside of that stock.
Which you're
when
somewhat
you
capping with your writing your call.
Because when you write your calls, you are capping your upside to some extent. You're writing the further out you write the calls, the more upside you get.
Yeah.
But the less income you drive.
Yeah.
The closer you write the calls to the current price, the more income you get. The more upside you lose. So adding a little bit of leverage gets the fund of one stock, better exposure to that upside that it's writing away with the calls. So most of them are a single stock with some covered calls and a light bit of leverage to try and get closer to that 1-to-1 beta.
Okay, so that's great explanation, by the way, and thank you very much, because actually, so you cleared it up for me as well, because in the sense that I was, when you hear the word leverage, you're like, oh, more risk, but realistically, all things considered, because of the mechanism of selling those calls, you are inherently bringing your risk closer to the actual stock. Okay.
Now, you were exposed 1.25 to the downside.
That is true.
So it's definitely better if the stock goes up. Like you are increasing your downside risk in exchange for income and not 100%, but close to 100% participation on the upside.
Okay.
Now, are they popular? Yes, they're growing relatively fast. There are, as I said, there's 85 names. I think 50 some of them are U.S. names. Very recently, there was Canadian names have been listed by a couple of providers. I think there's 30 Canadian names. That's top of my head. And I think the total AUM in that space is a little less than $2 billion. So it's not nothing.
No, it's not nothing.
And on the short time frame that these have existed, it's growing pretty fast.
Okay.
The natural competitor to these would be CDRs, which are just 1-to-1, holds one stock, is a stock. And those grew quite fast as well, partly because they had low stock prices, and because they have FX hedging in them. So it was considered a more convenient, if not cheaper, way to own U.S. equities. The counter to that is these slightly more structured solutions that are getting you exposure plus some income, and we're seeing them grow at a reasonable pace.
Awesome. All right. Well, that was great. Let's get to our next segment, answering the internet. So Patrick, what I did, we pull questions, from Reddit, from other sources online, and we just try to answer some questions from our audience. It's always a fun part. We screen through them, vet them. We make sure that you're in a position in your role and your expertise can answer a lot of these. I mean, you could answer all of them, but I tried to make sure that these ones were relevant to our discussion today. So the first one that we have, and this one is perfect, actually. Can someone explain the underlying mechanics of ETFs? Like, what is the role of authorized participants?
That's a great question. That's a great question. So, I got you. I have a good analogy for this. First of all, the real answer is an authorized participant is a market maker who is authorized to create and redeem, so make new funds, make new ETFs or cancel them out against the issuer, which is you. You're the issuer. I'm the authorized participant. In all respects, an ETF is just like a mutual fund, but only people that can get the mutual fund are authorized participants. What that means on a more sort of like day-to-day basis, though, is it's like your ETFs are offered on the shelf in a store. We're at Pharmaprix or Shoppers Drug Mart, depending if we're in Montreal or Toronto.
We are in Montreal, but most people that are listening are probably in Toronto.
So then we're at Shoppers Drug Mart, right? And we've got your ETFs. They're on the shelf. There's a certain amount of ETFs available on the shelf, and there's all the different Just a Touch of Gray for men, and then there's Touch of Gray for women, and then there's the beard one. Like, they're all there, and you can choose them. But there's only 3 or 4 on the shelf. And you, self-directed investor, you can buy all the ones on the shelf. But what if you wanted a lot for reasons that we don't need to talk about?
Who knows?
You got to talk to a stock boy to go into the back and get more.
Yeah.
You're not allowed as a customer to just go back into the back room and get more. And you're certainly not allowed as a customer to go to the warehouse and order more on a truck.
Yep.
That is the function of an authorized participant. We are the person that works in the store that goes to get more from the back or literally go to the factory and ask for more.
Yeah.
So we're managing the inventory that gets to the shelf for you to buy.
That's a great analogy. And I think a lot of people listening in will be able to understand that and make sure, like, we love examples like that. It makes it more tangible. And I think for some reason, a lot of the concepts in ETF land seem like they are fairly simple. It's just we put a lot of terms that are a little trivial to some investors, but that was great. Second question, what is the difference between NAV and market value?
I love this question because I get it a lot.
Okay, good.
NAV stands for?
Net asset value.
Love it. So the net asset value is
trying to put me on the spot on my own podcast.
I don't know. People all the time are like, no, talking about NAV. I'm like, do we all agree what NAV is? So NAV is the net asset value of a fund.
Yeah.
That's what the accountants say at the end of the day, once a day.
This is what we think it's worth. Yeah.
Not even you. Like your fund accounting does.
That's what I'm saying. That's what they're saying.
That's right. So that's marks to market against a bunch of closes or against midpoint if it's a non-exchange listed asset. Who knows? It's an accounting number now.
Yeah.
The NAV versus
market
last
value,
price. Market value.
Or market price.
Market value is the last price. That's what was observed in the exchange on the listed exchange. Last person that bought this ETF paid $52.50. That's the last price. The last price can vary from NAV depending on how often it trades. The best way to think about those differences is like NAV. First of all, it's backward. NAV is theoretical price.
Yeah.
It's not always a transactable price, and it's at one point in time, which is
a stamp in time.
Either yesterday at 4 or tomorrow at 4, or today at 4. Last price is like live; it's happening, right? But the other thing is, think about NAV is a little bit like if you ever buy and sell comic books or any kind of collectible. There's like a blue book that tells you what it's worth, or your used car. Your used car will have a book that tells you that your 2020 Ford Explorer is worth $42.50. But then when you go to the dealer and the dealer's like, yeah, well, it's a bit scratched.
I'll give you 35.
You're good at 41.
Yeah.
And you're like, but it says $42.50. And he's like, well, it's 41. What is the real price? 41 is the price that he's willing to pay.
No.
$42.50 is what the blue book is worth. The real price for any asset is what someone's willing to pay. It's not what the accountant said it's worth. So we do see sometimes divergence. And look, in ETFs, it's not $1,500.
No.
It's a penny, it's a quarter penny here and there. But the difference between the NAV and the last price is what it actually transacted for, what were real risk assets, real money paid for a real asset. What was that versus what did the accountant say it's worth?
Oh, that's a great example once again. And it does come up to us as well often because when, we're dealing with whether it's advisors or investors asking, sometimes there's slight dislocations. Why is that? Oh, well, the underlying, that's what people are willing to pay for it now. But it's also like to a certain extent price discovery on certain things that might have become stale, right? Like if we remember a period like March 2020, so that example for a car was great. The one that I used was it's like when you're selling your house, right? Like the municipal assessment.
Yeah, that's a good one.
Versus the market price is like, you'd love to buy houses. Anyways, right now in the market we're at, which is probably the opposite 10, 15 years ago where the assessment was higher and you would buy lower. Now it's the assessment's here and you got to pay this, right? Yep. So it's kind of you're off of stale kind of information that maybe is not as, like you were saying, instant or real time. So that does happen, especially when we see a bit more volatility in markets and maybe certain asset classes that are less liquid.
Yep.
We've got a lot more. I'll ask one more because time's flying already. Which one should we pick here? There's a couple good ones. What am I missing with 2 times leveraged ETFs? So we mentioned 1.25. 2 times leveraged ETFs. Why are they so risky as a buy and hold?
This is there's a short answer and a long answer. I'm going to give you the short answer, but the long answer is please ask
somebody who knows
for the real color, okay? Yeah. The short answer is it's called path dependency. So the 2 times levered ETFs are generally struck against a total return swap that is trued up every day. So if the stock is up 10%, the performance of the underlying asset is up 10% that night.
Yeah.
If it's down 10%, it follows down 10%. Now, if you draw your graph of your overall portfolio, it doesn't have to be a total return swap, up 10% from $100 is $110. Down 10% from $110 is $11.
Yep.
So now you're at 99. You were up 10 and down 10, but you're at 99. So because these assets, the underlying assets in the ETF, are trued up every day against the swaps that underpin them, there is a path dependency that results in erosion of NAV.
That's great. Great answer. All right, we got time for one more. I bought a thinly traded sector ETF, and the last price didn't match true value. How should I think about bid-ask spread and using limit versus market orders? So maybe there's a couple things to unpack there, but
limit versus market orders.
That's an easy. Yes, let's start with that one.
We generally counsel that investors always use
limit
a limit order. I understand that using limit orders means you have to pay a little bit more attention to your order on your app or on your laptop. That is a hassle, especially if you're trading pre-market, right? You're trying to put your order in at 8 in.the morning because you got a job. Using limits is a hassle there. Typically, it still is a good way to limit your risk of an adverse outcome or an adverse price.
Bad fill.
I personally, when I'm trading ETFs in my own like RRSP, I will use a limit that is well through the last price. I'm willing to pay 10 cents too much. I'm not willing to pay $10 too much. So I typically use limit orders that are a bit away from the market. So it's essentially the same as a market order, but if I've read the ticker wrong or I've made a mistake or it's not open,
I've got time to.
It won't execute if I'm really wrong.
Okay.
So I generally say use limit orders, but use generous in the money limit orders that will make up for your delayed quotes or otherwise, right?
Fair.
Why is it different? The market
so
price.
it's more as like the last price deviates, and I mean, I guess for the most part, the way that I would answer is just that there's maybe some bad fills right at the end of the day type thing. Is like somebody puts in a market order.
With thinly traded ETFs, it doesn't even trade into the end of the day that often, right? So if your last trade is at 2 p.m. and your end of day valuation, your NAV is struck at 4, there's 2 hours of market risk to the NAV where the portfolio may have fluctuated. So the last trade for the stock, which is how the ETFs are valued in your portfolio, that's 2 hours old. So there is definitely like a variance there on those more thinly traded names.
Okay, awesome. Well, that was Answering the Internet. Continue to submit your questions. We love answering them. You can even send them to me on LinkedIn if you'd like. We'll make sure that we get them answered as much as possible. But obviously, we do have constrained time. We want to keep these nice, short, and sweet. Looking at 30-something minutes. So let's get into the part of the podcast. And I feel like we've been talking a lot already. So maybe I'll skip some of these kind of more easy softball questions. But I'll be asking Patrick some questions on kind of his role, so you guys get a better understanding, I think, of the market making world. So we've been talking industry, we've been talking ETF space, markets, but I guess my first question is, what gets you excited to get up for work as a market maker? Like, what's the fun stuff that keeps you going after the time that you spent in the industry?
Why do I go to work every day?
But it's like, yeah.
Why do I go to work every day? It's because I'm trying to provide for my family. God bless. But why do I enjoy doing it?
That was the question.
I'll give you 2 answers. One is touchy-feely and it's cute, but it's absolutely true, so I need to say it.
Yeah.
The people that I work with are extraordinary. Like, my team are smart and thoughtful and kind and wonderful to be around and incredibly collaborative. And so every day we're building new stuff that's kind of weird and wild, and we have great leeway to build new solutions and think of new businesses, and that's a really exciting thing to do. And that's kind of what's fun about capital markets in general. If you have a job on a large trading floor, it's open concept, lots of tools, lots of smart people, and you're encouraged to collaborate and just kind of figure stuff out. And that's really exciting.
Yeah.
More specifically in market making or in equity derivatives where I live, it's similar. That notion that things are always changing is really exciting. So if I worked at the widget factory and I had to just wake up every day and make another widget and then sell it to you, I wouldn't last very long.
Yeah.
But whereas in cap markets and in market making, every day we get up and the entire market is concerned with something different. So the analogy
you have
I
to
often
price
use,
30 new ETFs this morning.
You got to price my ETFs. Or even if I think about like being a generalist or a risk market maker. If I think back to the financial crisis, which you were in short pants. Yeah. But we as an industry,
high school, actually.
We as an industry learned like what mortgage-backed securities were in a couple of afternoons because it turned out they mattered a lot, and none of us knew about that. So this notion that you will come in every day and you may be forced in a real stressful hurry to learn a lot about a really niche thing you'd never heard of before, that's pretty exciting.
It's a great answer. How do you, your team, market makers, the industry, if you will, help Canadian investors? And, we talked a little bit earlier about the authorized participant side. Like, you guys are the ones going out and sourcing liquidity. Mm-hmm. Like, how do you guys help our ecosystem in the Canadian ETF industry? Like, once again, it could be probably a long-winded answer, but like a couple things that come to mind of the service you guys provide.
I mean, the basic function of a market maker is they are maintaining the ETF market.
Yeah.
Right. Like, so like the playing field on which you and your clients are making their allocations or their bets or taking their views. The playing field on which that happens is being maintained by the ETF market making ecosystem. The capital that we deploy to keep prices fair, in line with underlying assets, and available, like the sheer amount of capital that gets put to work to make sure that there is stock, ETFs and supply available to investors, and that there's somewhere for them to sell it to, that's an enormous
it's a big task. Yeah, absolutely.
Right? And the ETF business doesn't work without it. So that we and there are 3, 4, 5, 6 sizable competitors, and then like 20-something medium-sized competitors. The ecosystem that we're bringing is capital and pricing to these
competition
assets.
Also, right? Like in the sense that it's necessary to have multiple market makers to everybody.
Yep.
So
that's the everyday. And then the stuff that's a little bit more episodic is that when you guys come to us and you're like, we've got an idea for an ETF, we want to stick something in it. And we've got this idea, it's an idea or it's a factor or it's an exposure. Yeah. How do we do that? And helping ETF issuers like you guys figure out the cheapest, most sound, stable, safe way to bring those ideas to customers in a way that we can also price. That's kind of fun too.
Yeah, because, I mean, realistically, if we're going to launch a new ETF and it's maybe something that falls in the not so plain vanilla beta stuff, we're working with you guys to make sure that it's actually functional and tradable and liquid, and right?
Yep.
So that's another part as well. And I guess from my perspective also, I'll be completely selfish in saying that I love your guys' research as well.
Oh,
so
that's great.
Nice. And that's, I know, I guess, a byproduct of everything you guys do. But it's one of my favorite emails every week. And yourselves, but also a few of the competitors that you were mentioning, you guys do great work on that. And I think it really helps us understand. I mean, it's such a big market. It's such a big industry now, right? And even when I started 8 years ago, I feel like it's probably doubled in the past 8 years, right? So and there's just so many things, like the new launches you mentioned is like, if you guys weren't there, I wouldn't know about them. Right? So I try to, but I've got other things to do here at Fidelity. I'm not saying this, but if I hypothetically was saying this to you, the market maker is charging too much, spreads are too wide, they're stealing from me, what would you say? Hypothetically, I said that to you.
I would start with, how dare you? No, listen, that comes up a lot. I'm amazed at how often, not so much investors, but like, it comes up sometimes even when we're.
And this is not answering the internet, by the way. This is
no, I know this is you. It does come up, especially when we're, let's say, even at the ideation phase of looking at a fund and saying, here's what we think the bid-ask spread would be on that fund. Often the issuer or the underlying portfolio manager, like your brain, the guy that designs this portfolio, is like, that's crap. The truth is, like, these bid-ask spreads are naturally derived from competition and a lot of math.
Yeah.
And so, when a spread seems wide, it is typically wide for a reason. And it's because there's either explicit costs in the portfolio or high risk in the portfolio. There's time differentials. There's all manner of things that make an underlying portfolio more difficult or more expensive to price in real time during North American market hours. But the real mechanism that should help you feel confident that those prices are fair is that there's competition. If I price it at a price that's not reasonable, I promise the guy at the bank across the street will price it tighter.
Exactly.
And so when you look at the spreads and there's 2 or 3 or 4 of us all trading around those spreads, you can feel confident that we're all doing our best, because we would all rather win the trade over the other guy.
Absolutely. And I kind of wanted I wanted to give you the chance to get to that point, because that's really important, and we mentioned competition with regards to the market making landscape, if you will, is if you're mispricing it, somebody's going to take advantage of that and make some money off of it. Right. So there's not really that much money. It's not like there's always these big juicy opportunities to take advantage of stuff. So no, I'm fully on board with you guys, by the way. And again, it was hypothetically, like, if I had heard this,
I'm not offended.
I would never ask.
People ask this all the time. Because it is frustrating. You don't notice a spread in an asset that just gets priced in a box somewhere, like a mutual fund.
Absolutely.
But the spread is there. It's paid in some part, in some mechanism of the cash being deployed and the total expense ratio. It's in there.
Yeah. An
ETF, that spread, that cost of deploying your capital is explicit and it's visible and it's on the board.
Absolutely. Next question I have is kind of, and this is broad for US, Canada. Like, what innovation have you seen? We talked about a couple already with regards to industry trends and like the leverage stuff, the single stock stuff. But like, is there one innovative product solution that's come up recently that's really, you're like, that's pretty cool?
Yes. I mean, all the time, but the one that I thought
recently, let's say
the one that came out recently is it would be like the logical conclusion of a covered call writing fund. So we already talked about covered calls writing on top of an ETF, where if you write kind of far out, you have not much income. If you write really close, you give away a lot of upside. We saw an issue come out this summer that writes single day options, 1 day options, or zero. They're called 0 DTE, 0 days to expiry. Every single morning, it writes. So it sells options on its portfolio. So it's typically an index option. Sells it in the morning, covers it in the afternoon, or lets it expire. And that is adding that option premium intraday to juice the income. And the idea is that it's giving away hopefully less upside because, and historical research will show that an outsized portion of S&P 500 returns or equity returns are overnight. So you're not giving away that overnight upside. You're just giving away the intraday upside.
Interesting.
And so that's kind of interesting.
All right.
And how is it innovative? It's innovative because it's pretty hard to hedge. We have to be told as the market maker, we just sold this many 0 DTE, 0 days to expiry options. It yielded this much. So the NAV in the fund is a little bit up. And good luck. And so we have to adjust all our models on the fly. It's pretty exciting. The robots don't love it. I think it's cool. So that's where like innovation, what's cool and what's sustainable is at odds.
Next question, and this is something that we've talked about, obviously, because we are an active shop first, right, at Fidelity, and we've seen kind of the growth of the active space. I think over the last 3-4 years, it feels like in Canada anyways, in terms of like number of issuances, there seems to be a lot more active ETFs out there. In the US, I think I saw a stat, I think it was in one of your reports, there's actually more active ETFs listed than passive ETFs in the US.
Wow, okay, I believe you.
Oh, sweet, yes. But from an AUM standpoint, I mean, we're nowhere near, but just in terms of listing. So like, how do you see that split going forward? So once again, like 8 years ago, I think it was like basically 70-30, 70%.
In Canada,
70% passive, 30% active. It's gotten down a little bit, maybe like 62, something like that, or 63, or 60-40, let's call it. Or
the Canadian split is around 70-30.
Right now?
Last I checked, it was like 28% active.
Oh,
a number of listed names.
Listed names.
Not AUM.
Okay, AUM. I was talking about AUM.
But the thing that's tricky about that stat, and why I don't need to worry too much about what the actual number is, is the definition of what active is a little bit.
Yeah. Do you bundle active and smart beta, or do you bundle just anything that's not market cap weighted?
So your momentum fund is it considered active? Is it it's kind of tricky.
Okay. Well, for the sake of the question, let's consider basically anything that's market cap weighted indexes and anything that's not.
So almost all new issues
how do you see that evolving over time, let's say?
So in Canada, that market is mature is the wrong word because it's still growing fast and we're seeing lots of new issues, but it's more mature than in the US. Sure. In the US, by and large, there were almost no active ETFs because the way that the US ETF rules work with disclosure of holdings and some other stuff that's not very interesting, it was very difficult for an active fund to be in an ETF structure. Yeah. That changed in the last year. It's still underway. It's still playing out. But as a result, we're seeing a lot of active issuance in the US. So they're kind of catching up to where Canada already was, which is we have a lot of active ETFs. I see that trend absolutely continuing, right? If you have a legacy active mutual fund and you know that you have a lot of self-directed investors who prefer ETFs and a lot of younger advisors who prefer to structure their practice around ETFs for tax optimization, for bulk trading, for low cost, whatever the number is, you know that you're going to have to start distributing your active products, your active funds into an ETF wrapper. So that will continue to grow, and the assets will continue to follow it.
Okay. I got a last question for you. What tip would you give a young Patrick on investing? Caveat, you can't just say buy the S&P 500 and forget it. Or actually, depends when you would have started investing. You might have lost a decade. But anyways, what tip for younger Patrick investing?
That's a good question. Okay, so
doesn't have to be ETF related.
No, I got you. Let me do two answers.
Sure.
Number one, especially early on, your best source of investment returns to your portfolio, the best source of growth to your portfolio is saving. Okay?
Putting money aside.
So being diligent about that saving plan and doing it early and often and regularly will get you to some dollar cost averaging practices. It will get you invested for the long term. Now, is it S&P 500? God bless if you did that. But this is sort of a Warren Buffett approach, is to say that every month you set aside a certain dollar amount, and when prices are low, you buy a little bit. You will naturally buy a little bit more. When prices are high, you buy a little bit less. The dollar cost averaging over time will result in better returns. Plus, compound interest is the only free lunch in finance. This is known. This isn't my idea. This is Warren Buffett. Okay, this is a real thing. So, but definitely in the early years, your savings rate is going to be the number one driver of your portfolio growth.
Yeah.
That's advice to Patrick at 22.
Absolutely. That's advice to me in 2020.
Yeah, no,
it's never too late, but I get it. The earlier you start, the bigger the compounding effect.
And then look, I mean, in terms of my investing advice, I'd get back to that notion of 85% cheap beta, 15% action. Because the 85% allocation to cheap beta, whether it's 500 or whether it's a balanced fund, I don't mind. As long as it's there and you're contributing regularly, it grows. The other stuff is exciting, and that's where you can have outsized returns. But really, the true pathway to financial freedom and retirement and all the rest of it is to be contributing regularly to that 85% cheap beta.
Well, Patrick, this has been awesome. Thank you so much for doing this. Thanks for coming in our makeshift studio in our conference room. We're soon going to have our little podcast room. It's going to be great, but I hope everybody enjoyed this episode as much as I did. It's been really fun. We had the chance to talk about the industry, answering your questions. I had a chance to ask Patrick a bunch of questions about the role of a market maker, his thoughts on the industry, investing advice, all these great things. So thank you very much for tuning in, and we'll catch you next time on our next month's episode. Thank you very much.